What if a recession hit in the next few years? People in the media love to throw around that word, but they don't often provide strategies for you to implement to protect yourself against something like a recession. The question we should all ask ourselves is, am I ready to face a recession if it hit right before my retirement or even during my retirement where I'm drawing down on my portfolio? Well, in this video, we're going to talk about 4 strategies that you can implement to put yourself in the best position possible to face something like a recession and hopefully relieve some of the anxiety that's gone with all this uncertainty happening around us.
Yeah, I agree. The media does a great job of talking about recession, the R word, but doesn't do a very good job of talking about, well, how do you deal with recessions, particularly as retirees? So I'm going to share with you 2 stories that are really important in my journey, and they directly impacted my work with clients. And these 2 stories forged into our practice for years and years the 4 strategies that I'm going to talk about today. They're very personal experiences, right? So I've been in the business for a while, and the one story relates to the great financial crisis in 2008. And I had meetings that were very difficult. I had clients crying in my office. And it was during that time that I realized that the principles that we use to this day were extremely important and critical in getting clients through a very difficult time. They link up with what was causing the anxiety and concern. And that was, am I going to be okay? Do I have to go back to work? What is the ripple effect of this particular market correction on my personal planning? And so we're going to talk about those strategies. And one strategy comes out of my experience with my dad. My dad worked at SaskTel. There was a massive downsizing of civil servants and employees. And my dad was offered a package at 55, seemingly at the worst possible time it could have ever happened to him. Interest rates were going sky high in the early 80s. He was forced to take his pension. And when he walked home that day, it was a very dark, emotional day for our family. My dad thought to himself, how am I going to support my family? My kids are going to university. What are the next steps? And through that, there were some great lessons that ended up being positive. And I'll talk about that in the strategy section of this video.
Yeah, I can't imagine being an advisor in 2008. But similarly today, people have been increasingly anxious and cynical about achieving their retirement goals, and rightfully so. I think for those watching, it's good to know that they're not alone in feeling this way. It's extremely common. There's a great study done by Allianz Center for the Future of Retirement, where they made some pretty, not necessarily surprising findings, but they're sobering. So firstly, there's a confidence crisis underway. So people's confidence in their ability to support their retirement lifestyle has dropped by 13% since 2020. 64% of Americans are more worried about running out of money than they are of dying. People have significant gaps in their planning. So nearly half don't have a financial plan. And 59% admit they don't know what else to do other than just save money. There are overwhelming financial pressures like juggling for saving for a house, retirement, and even existing student loans. Now, what does this lead to? Well, people have a growing appetite and desire for predictability and protection. A lot of people, 74%, say they would prefer financial products that protect against major losses and end up capping the gains. So if you can see yourself reflected in these stats, stick around to the end of the video. It'll provide some alleviation for the anxiety that all the volatility is causing. And I think the key thing to remember here is that a lack of planning doesn't mean a lack of potential. And it's never too late to really think about your financial goals and start to plan for them.
Yeah, so true, Josh. It's really the emotional, psychological aspect that makes the whole R word recession tough. The reality is there are specific strategies. And you made the comment about, the study, and the study is sort of focused on there are product solutions. But the reality is there are strategy solutions, right? That's how you deal with recessions, not go buy a product that promises to fix the world, right? But a lot of financial institutions do that because they are appealing to our anxiety. So let's talk about just a little bit of history, just to give you some context, because knowing this context is really helpful. We have up here Canadian recession since 1950. And we've listed all the major recessions over that time period. I'm not going to go through each one. You can see, 90, 92, 2008, the great financial crisis I talked about. And that 81, 82 period was the period when my dad lost his position, was pensioned off at a very difficult time. And so we look at that. The other piece that we look at is stock markets versus recessions in Canada. Now, this is a normalized curve. I'm not showing you in this chart the ebbs and flows of the market. Generally it's up, but is tracking each of the recessionary periods in the highlighted areas, and then tracking the normalized movement of the TSX during those time periods. These trends are instructive because they're showing us how the market sort of responds to these recessions, either in advance or after. So what you're seeing here is that the markets often has peaked in advance of a recessionary being called. So what happens is The market's always looking at 3, 6, 9 months ahead, aggregating the data and anticipating. And you can see in this chart that the market peaks, it begins to decline often before the headlines are saying that we're in a recessionary cycle. And then you see the recovery begin sometimes even before the recession is over. Now, this is really important. We're going to talk about this in the context of the strategies, right? What does this chart show us around the strategies? This chart is the Bank of Canada interest rate policy versus recessions. Again, what you see is in the early 80s, you see that peak in interest rates when my dad lost his job. Embedded in the little peak in rates was an opportunity for my dad that he didn't realize at the time, but we'll talk about that. And then we'll go back to the 2008 period, the precipitous decline that happened actually long before the recessionary cycle hit. And then what we've experienced since this time is very low interest rates. Rates of late have gone up a little bit for sure. And now it looks like they're beginning to come down. The fear around recession is sort of gripping the Canadian landscape. But even in that low interest rate cycle from 2010 on is embedded an opportunity that we'll talk about. And then, of course, this last slide sets context. So the way you want to look at recessions, it's sort of like market cycles. The stock market in general is up 75% of the time and down 25% of the time. We know that over every 10-year period, it'll be probably 2 years that will be losing years. But if you step back and look at all these recessionary cycles in the dark green in this chart, yeah, they're not fun. And of course, there was a dramatic one right at the beginning of this chart. But the ebbs and flows of the market are such that the market on average is up and you get through the recessionary cycles fine.
You make a good point. Recessions are often called in the 11th hour. We've been experiencing the effects of recessions, and then they're like, oh, we're in a recession now. It's like, oh, thank you. Well, we know.
Exactly.
Shaun, what's the first strategy that people can implement to protect themselves against a recession?
Well, there's sort of 3 things within the strategy, but it really is have a plan, have your budget in place, and make sure you're employing either the 3-bucket strategy or a timeline strategy in your portfolio. So the way you deal with recessionary cycles is you don't try to respond to them from a market timing standpoint or anticipation, because it's going to be very difficult to get those timing decisions correct, right? So let's talk about the plan. When I go back to 2008 and I had those clients crying in my office, what do you think the single most important thing I did in that moment to help them have context and hope for their future when things looked so bad at that time? Well, we pulled out the plan. And I said to them, we're doing this plan. We do the plan on a regular basis. We did expect some variability of return. We did build in a modified Monte Carlo sequence of return risk scenario. I believe we can get through this, but let's just take a look at things. And so what I was doing with clients is I was saying, okay, we've got a new normal. We obviously were not expecting a minus 23 or minus 30% return for the year. We didn't build that into the model. So let's do a reset. We're going to redo the plan. We're going to use the new values that we're currently sitting at. And then we're going to use, a nominal return that's relatively consistent with what we think the long-term averages are going to be, nothing super aggressive, and then push into the future and see what the plan looks like. Well, you know what I found in almost every situation that I did for clients post-correction is that the plan confirmed that they still facilitate and look after the retirement income. Their retirement was not compromised. Yes, it's been a devastating market correction, but they're still okay. The plan confirmed that we can still make this work. Now, how it could work was different for every single family, right? For some families was, maybe the terminal value of the estate might be lower. They had some legacy and gifting aspirations, and some of those things might have been compromised. Maybe the buffer room, right, in the plan was less in terms of how much capital might be left longer term. Some clients, I did suggest to them that part-time job that they were thinking of not keeping prior to the correction, that they keep for a little bit longer. And for some clients, and this was not a fun conversation, but we talk about the trifecta of risk management in planning, which is have your cash wedge in place as part of the 3-bucket strategy. Make sure that you've got budget flexibility, that you can move your budget back and forth depending on the events, and have a line of credit in place. Why the line of credit? Well, if you need access to cash flow when the market's down that precipitously, and a good chunk of your portfolio is in an RSP RIF account where you have to pay 20 cents on the dollar when you pull money out, that's devastating. And so we had clients that when we modeled the line of credit, we said, let's use the line of credit to fund some cash flow. And then we expect that markets will recover at some point. As they do, we'll pull money from your accounts to pay down that line of credit. So that was much more cost effective, right? Might cost, I think it was maybe 5 or 6% a year to get that money out from an interest standpoint, way cheaper than paying 20, 25% tax by pulling the money out of the registered account. So we had to think from a balance sheet standpoint how to get them through that very tough time. But the planning made all the difference in the world. So the other piece is that, like I said, the budget flexibility. We knew going into every single year that we'd built in a differentiation between discretionary expenses and non-discretionary expenses. Simply just moving back for a while from discretionary, reducing that part of the budget, and just maintaining the non-discretionary budget made a huge difference in their planning. So that was the first strategy. And the planning piece and updating the plan was huge for people. It was a massive piece of mind. And I think that's why a lot of people have anxiety through these periods, because they have no context. They're like a ship on the ocean being buffeted back and forth by the waves and the winds. And they have no way of sort of assessing context to see whether they're still okay. And that plan helps to do that.
Yeah, you just need something to reference when you don't know what direction to go or how things are
Exactly.
progressing. You just need something to reference. All right, so what's strategy number 2?
Well, strategy number 2, and again, if I go back to 2008, but every market cycle we've gone through, and there's different definitions around portfolio quality, but I'll just be, relatively succinct here. When it comes to portfolio quality, when you build a portfolio, and we use investment strategies with a firm called Dimensional Fund Advisors, and one of the things that they do as it relates to their portfolio composition is to make sure that they are focused on profitability of companies putting into the solutions, that they are always paying attention to the book value or the valuations of the companies before purchasing, and that they're focused on broad diversification with the idea that we can't time these situations. One of the best ways of navigating these economic events and recessionary cycles is don't hitch your investment wagon to one area. So one of the big difficulties, obviously, is if I've got lots of money in Canada and Canada goes through a recessionary cycle, I may be going to be in a tough spot, potentially in my portfolio. So we want to make sure we have broad diversification geographically. So if we did get hurt in one area from a recessionary cycle, maybe the other areas in our portfolio will be more resilient through that time period. And then in addition to that, that quality aspect is having the discipline to recognize, and we go back to the charts that I showed you before, that when we see recessionary cycles happen, we see this ebb and flow of interest rates. Rates begin to go up prior to recession often because the economy is heating up. Now we go into a period of recessionary cycle, rates begin to come down. And almost always, it's a signal to you to rebalance back into equities. So one of the things that happens for folks through these economic cycles is they begin turtling and they become very risk adverse. That's a natural human instinct. And yet rebalancing your portfolio to seize upon the opportunities for clients when they go into this recessionary cycle is really critical. Good example. Let's go back to the early 80s when my dad got his package. What was the opportunity embedded for my dad? As it turns out, he was required to take his pension value and buy an annuity. Well, that life annuity, he didn't know it at the time, but in the early 80s, he ended up locking in a long-term annuity rate at the highest interest rates that we have ever seen. And so what was a really negative for him ended up being a long-term positive as he locked in this income stream for the rest of his life at a much higher rate than normal. And so we can apply that lesson by paying attention to interest rates. What does the strategy look on the fixed income or cash side of your portfolio as interest rates are going up? What does it look like when interest rates are low? What are the strategies to keep those yields in play? And so embedded in both the stock market and the GIC bond market are opportunities through these recessionary cycles. And if you look at, particularly the stock market, getting back in during a recessionary cycle where rates are low, there's usually a correlation there. As rates fall, money's cheaper, there's more liquidity. You want to seize those opportunities. Sometimes, if you don't have a financial coach in that situation, more often than not, you're not going to seize the opportunity. You're going to turtle, right? But if you're working with someone that can kind of give you a broader perspective and encourage you to make the high probability decision, the probability is that you'll be a winner through that cycle. As markets contract, you buy in that opportunity, and that also ties into the absolute imperative necessity of systematic rebalancing in your portfolio to seize opportunities through the cycle.
Yeah, that's really good. I mean, I don't want to spoil the other strategies, but even Tiger Woods has a caddy who helps him read the greens, Even Tiger Woods has a coach. So it's really important to have other people involved in your planning. All right, so what's strategy number 3?
So strategy number 3 is specifically having guardrails in your plan. You need to have trigger points that initiate action on your part when certain things begin to happen. Okay. So let's say you have a particular withdrawal rate on your portfolio investments for your retirement income. And as long as things are going according to plan and you're getting returns and your tax exposure is within the band you're anticipating, hey, that's good. You just keep going with the strategy. But what happens when black swan events or market events happen? What is going to be your signal that you need to make adjustments to your planning? So when we work with clients, want to make sure that we've got these signals, these trigger points, these guardrails in place to start the discussions about, what, we're at a point we need to make an adjustment. So one example is, let's say that client's taking out on average a 4 to 5% draw on their portfolio. That is a sustainable draw based on the assumptions we made in their planning. But then we see a 15% correction in the stock market. Well, that particular signal is going to trigger a conversation and potentially trigger an adjustment in the cash flow plan. Remember, we have the two budgets, right? Non-discretionary and discretionary. The client will need to potentially, when that trigger hits, to pull back on their spending and go back to the non-discretionary expense budget for a period of time, right? So that's the natural implication. And what happens for too many people is because they don't have those trigger points, they're kind of wringing their hands. They're not sure what to do. They're hoping things are going to get better. They don't have any kind of discipline in their planning. And then they get caught and they get hurt financially. So it's really critical to have the guardrails in place and then also have what I call the opportunity engine, which I alluded to in the previous discussion. Make sure that when these events happen, embedded in recessions are investment opportunities for those that have education, a plan, and they are disciplined. And I haven't seen a period historically when we go through recessionary cycles that when people acted with discipline, they weren't rewarded positively from an investment standpoint by acting on that discipline.
Yeah. Often the best thing to do is just stay the course. Don't make any irrational, quick moves based on things you're seeing in the media and just wait, but actively wait.
Yeah, exactly. And when we're pointing on the trigger points, I talked about the trigger points on the way down, but there should be trigger points on the way up. Right. So again, for retirees, it's really easy to fall in love with your investment portfolio when it's doing really well, and they forget about the plan. You got a cash flow, you got a burn rate here that you're using to spend money. And so the trigger point on the other end of it is you've had above average performance, above, our modeling for you. Your trigger is you need to capture those profits and protect them because that money is earmarked for future income payments.
Yeah, for sure. All right. So we talked about the importance of planning, different strategies, portfolio quality, guardrails, looking at your expenses. What's the fourth strategy? And I think you would argue this is a really important one, kind of brings everything together, that people can implement to protect against something like a recession.
Education. If I had to boil it down, there's nothing more powerful than just educating yourself and equipping yourself with an understanding of these basic concepts. If you look at recessionary cycles, they're pretty short in the grand scheme of things. There's ways of protecting yourself when you go into recession. It's hard to predict them, but when they happen, using the strategies we've outlined already in this video will help you to get through them successfully. And then you need to arm yourself with just good quality information and be educated and informed on the topic. Now, you don't have to become an expert, but there's basic strategies and educational concepts in both economics and finance and financial planning that if you understand them, the power of education is it'll get you through those difficult times because you're going to make decisions based on the education and the probabilities and not on the headlines screaming at you every single day where it's just about eyeballs, viewership, and getting your attention. And like you said, Josh, at the beginning of the video, they're not trying to inform. They're trying to create fear and anxiety. And what we want to do through planning is to create confidence and peace of mind. And you do that before you go into a recessionary cycle. You got to equip yourself before then.
Sure. All right. If you're watching this video and you don't have a plan in place, like what did I say earlier? I think it was like almost 50% of people don't have a financial plan, and you want to talk to someone about that, or you just want resources to do the planning yourself. Make sure you go to our website, a ton of free resources, or you can schedule a meeting, 30-minute meeting, talk to Shaun and see if we could help you with your planning. I think that's all for this video. Thanks for watching, and we'll catch you in the next video.